Welcome everyone. Welcome to SQE1. Here in chapter 7, we look at how interest works when solicitor hold client money. This session is all about responsibility. The central idea is simple. When you hold a client's money, you do not just look after the money itself, you also look after the financial benefit attached to that money. So we often forget about Rule 7. A solicitor must pay a fair sum of interest unless there is a proper written agreement saying otherwise. And in this session, we show how it works in practice. So uh, on this slide, we talk about obligation to pay interest, and that reminds us why the obligation exists. Client money must stay safe and accessible for its intended purpose under Rule 7. If the firm holds that money, even for a short period, it may generate interest. And that interest belongs to clients, not you. So Rule 7 requires solicitor to pay a fair sum of interest or a sum in lieu of interest, but there is room for flexibility. A solicitor and client can agree something different, provided the agreement is in writing and the client genuinely understand what they are agreeing to. The practical takeaway is that transparency and informed consent protect both the solicitor and client. So the next thing that we need to understand here is client money in a separate designated deposit account once you got it. This slide introduces the first method of holding client money, a designated deposit account. That is an account opened specifically for one client. Because the money sits on its own, the firm should aim for a reasonable interest rate. So our example involved £800 being transferred to a designated account for Mr. Richard Baker. The full entries must be made in both the general and designated ledger. And here we go with the entries. So first entry, debit Mr. Baker's ledger account £800 in client section. And then credit cash account £800 in client section. So second entry that we need to do it, debit designated deposit account £800 in client section and credit Mr. Baker's ledger account money on deposit £800 in client section. These entries show that £800 has moved out of general client account into a specific designated deposit account for Mr. Baker. This creates a clear audit trail for the SRA and for the client as well, that where money moved from and where it has landed with specific entries. So interest earned, designated deposit account, and it got interest on it. Several months later, the bank pays £50 interest. Because this interest belongs to Mr. Baker, it must be recorded in his ledger. The correct entries are debit designated deposit account £50 client section and credit Mr. Baker's ledger account money on deposit £50 in client section. So that simply shows the deposit increased by 50, and that 50 is allocated to Mr. Baker in practice. So at that point, this keeps ledger transparent and avoids any suggestion for the firm benefiting from client interest. So all of that entries, we need to keep in mind both of the entries. So now if you are transferring principal and interest to general account, so here the 850, which is 800 principal plus 50 interest, is moved back into the general account before payment to the client. At that point, the entries will be debit cash account 850 client section, and then credit Mr. Baker's ledger account 850 in client section, two entries, and then the money moves to the next step. And the correspondence reversal is like debit Mr. Baker's ledger account money on deposit 850 client section, and then credit designated deposit account 850 in client section. So now when the solicitor pays Mr. Baker, the final thing, the money is going back to Mr. Baker. First, it moved to general client account, and then it moved to Mr. Baker. It is going to Mr. Baker. At that point, you need to get the final entries. And those are debit Mr. Baker's ledger account 850, 800 plus 50 interest, all of it in client section. You need to put this entry. And another entry you need to put it is credit cash account 850 in client section. So in this way, you complete transaction. So first was money moved into designated account. We made entries, and then in that account it earned interest. We made entries of that one. Then we got that money back to client account that we got, a general client account, and afterward we paid it back to Mr. Baker. I hope this makes sense to all of us. If it does not, go back and just revise, redo it, re-listen it. Okay. Client money in a general client bank account. So at this point, this covers the second method, money held in a general client account. So even here, the solicitor still needs to account to the client for interest that should fairly be due. And it is interest obligations that you need to account for to your client. So banks often pay interest directly into business account, not the client account. This is standard practice, but the firm must then calculate what belongs to each client and move it into the client account. This prevents the firm from benefiting from client interest. So let's see this one, how it works. So transfer from general client account to general deposit account. So now we look at pooled money, that is 50,000 held for multiple clients in one client account. The transfer goes from general client account into general deposit account. The entries are debit deposit account 50,000 client section and credit cash account 50,000 client section. This is a bulk movement often done to earn a better interest rate on pooled client funds. The firm must still calculate each client's share fairly, but don't forget you can have a different agreement with different clients. So at that point. So I hope it works. So interest paid to firm by the bank. The bank pays 750 interest on the £50,000 deposit because the bank pays this directly to business account. The entries are debit cash account £750 business section and credit interest received 750 once again business section. So both debit and credit balance one another or each other. This shows that a firm has received the interest, but remember, it does not belong to the firm. It belongs to the client whose money generated it. So the next job is to pass on the appropriate amount. And let's see how it goes. So transfer interest to the client bank account. The solicitor calculates that Mrs. Patricia Williams must receive £50 of that interest. So how it works? The first step is to show the firm giving up the £50. So debit interest expense account £50, and that will be in business section because those are giving away. And then credit cash account £50 business section, so money moves from business account. The second step is paying into client account, from business to client account. And now in client account the entries are debit cash account £50 client section and credit Mrs. Williams ledger specific ledger account £50 in client section. Now, the solicitor pays Mrs. Williams the interest along with 500 already held for her. So it will be like this. Debit Mrs. Williams ledger account for 550 and that will be in client section, and credit cash account 550 once again in client section. Both of them, they mirror each other and they balance the total balance sheet. So, paying interest directly to client. Sometimes the firms pay the client directly rather than through the client account. Usually when ledger balances are already settled, the entries are like, debit interest expense account £50 in business section and credit cash account once again £50 in business section. So a memorandum note is placed in the ledger to show that this interest has been paid to client directly. So reducing the client's debt. Here, the client owes the firm money. instead of paying the interest to the client, the solicitor reduces the client's debt. So the client, in this case, will get entries like debit interest expense account £50 business section and credit client ledger account £50 in business section. No money moves. The client simply like owes less in this case, and this is common in real world when clients they owe money to the uh, to the firm. So another thing is client money withheld from the client account. That's important to understand. Sometimes money is held outside a client account, maybe in an office safe or an account that is not a client account. Even then, unless there is a valid written agreement, the solicitor must pay fair interest to the client. This prevents solicitor from benefiting from interest by quietly holding money somewhere inappropriate. It reinforces Rule 7's purpose, the financial benefit of client's money, and that financial benefit should go back to the client. That's it. Unless and until there is exception and the agreement is like there is a written agreement between client and solicitor. And also they need to just make sure they have appropriate records in place. So SQE1 tips and pitfalls. We need to identify account type first, like always determine whether client money is in designated account or general client account. And this delegates the accounting method and interest payment process. So from there it starts. Was it in common client account or was it in designated account? We need to record all entries. Once again, I say money moves from one account, put entries. Money lands in another account, put entries. And remember, we got double entries. So we need to look at a written agreement that can change the interest recording. And we need to track business account interest and where the money is coming from. So common pitfall, paying interest from incorrect accounts at that point, and it becomes confusing. And overlooking the external holding for getting to account for interest when the client money is held outside standard account and we think that we don't need to pay. So the rule of thumb is we need to pay whatsoever we make from client's money. So, and also sometimes we fail to look at memorandum notes and all, and sometimes we don't look at, interest rate reduction once client owes money to the firm. So I wish you all the best. Like it looks a bit tricky, but once you go through it a couple of times, you will understand it all. I wish you all the best. Take care. Ta-da.